Hello, everyone. This is Alexander, your host of the Morgan Millennial Minute Report. The show is brought to you by David Morgan of themorganreport.com. Before we begin, if you could subscribe to the channel and leave a like on the video, that'll be really appreciated. So today we're having a very special guest named Jason Hartman, who has achieved the American dream through real estate. Hello, Jason. How are you today?
Good, Alexander. It's good to be here.
Oh, thanks for being on the show. So I would like to ask you a little bit about your Hartman Comparison Index.
Sure. Yeah, absolutely. So, when people try to figure out whether or not the real estate market is overvalued or undervalued, they tend to go about it the wrong way in many ways. There are lots of methods, lots of opinions on this stuff, but I find that pretty much everything in life, every decision we make, is a decision at its core based on comparison. So if we want to understand the value of housing or the value of oil or the value of stocks or anything, right? The value of a new shirt, right? How do we determine that? Well, we determine it mostly by comparing it to something else. And traditionally, people just compare it to dollars, right? But as you well know, the dollar is a moving target, right? The dollar sometimes has more value and less value, usually over time, less value because of inflation. But there are little spurts where the dollar can be lower and higher in the short term. And comparing only to one thing, just to dollars, is a huge, huge mistake because the dollar is not stable. It's not a thing to compare to because it's a moving target. So what I say, and if you can see my screen for those of you watching, and I know some are only using audio probably, so we'll explain what we're looking at to you. It's all about understanding what measuring stick you're using, so that if you're using the right measuring stick, or better yet, multiple measuring sticks, not just one, not just the dollar, for example, or the euro or the yen or the peso, right? You're using multiple measuring sticks. You can better understand how to know if something's cheap or it's expensive, if it's in a bubble, if it's overpriced, or if it's not. And that's what we'll explore today. And before we get into that, I do have one side thing I need to tell everybody. In a country as large and diverse as the US, there's no such thing as a national housing market. There are a whole bunch of markets in the US, literally thousands of real estate markets, but they can all be categorized into one of three categories, I think, Alexander. And one is linear markets, and those are the markets that encompass most of the geography of the country. They're stable markets where the prices don't go up too much and they don't drop too much. They just sort of plug along and they're pretty stable. The other is the cyclical markets. And these markets, if you're looking at a chart or a graph, they look like a roller coaster. They have really big highs where they're really up and then really ugly times where they're really down. And those are the markets that unfortunately get most of the media attention. They're not that big geographically speaking, but they get a lot of attention. So they include the West Coast of the United States, South Florida, where I live, and the expensive Northeastern markets, Washington, D.C., New York, Boston, etc. And those are the two main types. And then there's an in-between type called hybrid markets. So we recommend that people invest in linear markets that offer really good income, good cash flow, and they're more stable because they don't have those big downturns. And so that's the first thing I want everybody to understand. Does that make sense?
Oh, yes, it does.
Good stuff. Okay, so let's move on and let's ask the big question. The listeners to my podcast, the Creating Wealth Show, are always saying that this question should be dubbed the Jason Hartman question, because the question is compared to what? And I say it often because it's such an important question. Comparing things are really the way to establish value. So we're going to look at real estate and we're going to compare it to other things for a few minutes. And that will help us determine whether or not it's overpriced and the market is likely to crash, or if it's underpriced and the market's likely to keep going up. How's that sound?
That sounds good.
Okay, cool. So is it cheap or is it expensive? So the index I developed is called the Hartman Comparison Index, or the HCI. And the HCI takes a whole basket of commodities and services, things that everybody needs and everybody uses, and compares them to the price of real estate today and then back historically in time. And I think it's very, very enlightening when we look at that. And it really does answer the question, are we in a bubble, or when will the bubble pop? Right. And so we do that by looking at what I call packaged commodities, which are the ingredients that go into a house. So those are glass, steel, lumber, copper wire, petroleum products, concrete, all of these things, right? These are all the things that make up a house, and energy, of course, too, right? And another technique I teach, which we're not going to have time to cover today, is called inflation-induced debt destruction. That is the way people can basically beat inflation by using debt strategically. And so we won't have time to go into that today, but I just want to tell you that it's out there in case anybody wants to learn more. And they can get a free book at pandemicinvesting.com that'll teach them about that and some of my other techniques that are kind of adapted for today's crazy times we're living in, pandemicinvesting.com. Okay, so if we look at home prices historically, and this goes back to almost 1950, and it compares the consumer price index to the Case-Shiller index. And the Case-Shiller index is commonly used to value real estate. And I think it's very flawed. It's not a good way to value real estate. And the consumer price index is how we measure inflation. And that also is very flawed. But since it is the widely used index, we'll go with it. And you see that most of the time, Alexander, these two things are pretty parallel, but they started to get way out of sync in the late 90s, where you saw the Case-Shiller index of housing prices go through the roof. And then they peaked, and then we had a big crash, right? Everybody knows that. And then the market's been coming back since then, and it's getting out of sync with the consumer price index. But again, that's only one comparison. The consumer price index is one comparison to housing prices. It's not enough. It doesn't give us enough information, and it's highly manipulated. Now, one index I do like is called the Housing Affordability Index, published by NAR, or the National Association of Realtors. But even that index is pretty flawed. So hopefully the Hartman Comparison Index is better than all of these. And so let's take a look at it. You ready?
Yep.
Cool. Well, let's look at gold and compare the price of gold to the price of the median house. The typical house in America, if you want to buy a house in gold, how much gold does it take to buy the house? Right? That's a good question. Okay, great. So back before you were born in 1970, going way back, to buy the median price house that was only $22,600. And gold was only $35 an ounce. So it would have cost over 600 ounces of gold to buy a house back then. 10 years later, by 1980, the median house price had tripled in dollars. So it's now $66,000. But gold has gone up tenfold to $653 an ounce. So in 1980, to buy a house, it would only cost 102 ounces of gold. Pretty amazing, isn't it? Yeah. Even though we thought it was more in dollars, but it was really a lot cheaper in gold. So if you were saving money to buy that house for 10 years, it would have been better to save that money in gold than dollars, because the dollar went down in value, but gold went up in value, right? But it doesn't always happen that way. So let's keep going. So if we jump ahead to say 2000, we go 21 years ago, the median house price is $173,000. Gold is $283 an ounce. So 21 years ago, it would be 610 ounces of gold to buy a house. Now let's fast forward to today, to June of this year. Gold is $1,787 an ounce at this time. It's not exactly that today, of course. A median house price is about $348,000. So it would only cost 194 ounces of gold to buy the median price house. So compared to what is the question here, right? Compared to gold, houses are actually quite cheap. But isn't it funny that everybody, Alexander, thinks they're expensive because they're only comparing them to dollars?
Yeah, it's true.
Can you see how people could be easily misled here by only comparing things to dollars? Because priced in gold, houses are actually very cheap. So priced in gold, if we ask the question, is it cheap or is it expensive? We'd have to say it's historically cheap. Houses are historically cheap. Okay, Bitcoin is another comparison, but it's not a very good one because Bitcoin's too new. But priced in Bitcoin, houses have gotten a lot cheaper since Bitcoin came out. Okay, but again, not a long enough track record. Okay, so let's do this one. Let's do oil. Oil, arguably, is the world's most important commodity. The whole world runs on oil. I don't care what Elon Musk and Tesla say, oil is still the thing that runs the world, no matter what anybody says. 1970, let's go back there. Houses are about $22,600. Oil is only $3 a barrel. It would be 6,700 barrels of oil to buy the median price house in 1970. By 1980, oil was 11 times more expensive, $33 a barrel. Houses were 3 times more expensive at $66,000. So it would only cost you just over 2,000 barrels of oil to buy the median price house 10 years later. So priced in oil, houses got more than 1/3 or more than 2/3 cheaper. Great buy, right? Okay, let's look at today. Now remember, back in 1970, it was 6,700 barrels of oil to buy a house. Today, it's only 4,600 barrels of oil. So priced in oil, houses are cheap, not expensive. And we can do this on and on. We've got over 40 things in the Hartman Comparison Index, but that just gives you a sample of it. And I hope it's helpful because it really does show you that houses, historically speaking, are just not as expensive as people think they are. They're actually quite cheap compared to a lot of other things.
Yeah, I find that really interesting because it shows that housing prices are actually going down if you compare it to those commodities. So a big question I had, uh, I don't know if you have a comparison on this, is the birth rate. We see America's having a very huge, the birth rate's declining. So I was,
Yep.
so I was wondering how that's going to affect the housing market.
Well, that's a great question. And we talk about demographics a lot on my podcast and my YouTube channel. And ultimately, it will not be good for the housing market, but it's a long ways away before it starts to matter. The birth rate has been dipping, but again, you've got at least a good 22-year lag before those people move into apartments, right? After they're born, probably 25 or even more years most of the time nowadays. And then before they actually buy their first house or even rent their first house, because mostly they'll rent an apartment, right? They might be in their 30s. So that does matter, but it doesn't matter that much because it's a long ways out. But definitely something, if you're looking at 20 and 30 years in the future, definitely something you should be thinking about. But again, today, it's just not an issue yet. Currently, we have a housing shortage, and they are not building homes fast enough for people. And we've also got to remember that a lot of the housing stock over time becomes obsolete, where people just don't want it because the houses just get too old and they need to be torn down and rebuilt or completely remodeled.
Yeah, I definitely agree with that. So it's a more long-term thing, like a generation of people. Yep, that
Yeah.
makes pretty good sense. So could you tell the viewers your real estate market outlook for the next 10 years?
I think that the market and when you say the market, that's a loaded question, by the way, because what does the market mean? Does it mean the market for selling real estate? Most people think that's a good market. It's a seller's market, right? But it could be a buyer's market, and buyers would think that's good, right? And so then we got to talk about renting, or and how is it for the landlords, right? Is there a shortage of rental supply causing rents to increase? So what is the outlook on the market? Well, it depends on a lot of things. No one has a crystal ball, of course, but it also depends what type of market we're talking about. So let me dice that up for you. I think for the next couple of years, the market for sales will be very strong. I think that there is a shortage. It's going to be with us for a while. And I think we can look for a fairly strong real estate market, although, slowing down a little bit probably for the next couple of years. And the same is true for rental housing. The demographics coming at the rental housing market for the next 10 years are fantastic. A lot of rental demand.
Yeah.
So, yeah.
So you talk about individual markets within the United States. So I wanted to ask you where you thought the best investment properties are located in the United States.
Yeah, that's a great question. If people go to my website, they can see a whole bunch of markets that we recommend, and that's jasonhartman.com. Just click on the properties page at jasonhartman.com, and they can see all of these markets we recommend. So right now, a lot of people really like Florida, where I live. There's a lot of inbound migration to Florida. But other good places are Texas. Alabama is very good. Alabama's doing really well. Tennessee, Little Rock, Arkansas is another really good one. But I'd say a lot of the action is really centered around Florida right now. Florida is a very desirable place at the moment.
Yeah, it's definitely really nice in a lot of Florida. So, what's your opinion then on full-time rentals versus vacation rentals? Which do you think will be better long term?
The vacation rentals are almost like Bitcoin because they just don't have a very long track record. People tend to forget that. The whole concept of vacation rental really didn't even start until about the mid 70s. And then it didn't even really catch on until Airbnb came along in maybe 2006 or 7 or something like that. So it didn't even really get a foothold until about 8 years ago in any big way. Okay. And it's very dependent on one company, which is Airbnb. Of course, there are others, but it's like saying, what are we going to compare Facebook to? Not much. There's just one really clear leader in that marketplace. So I think the track record is really short, and I think people ought to be very careful, and they ought to analyze a deal when they go into it of how good is this real estate deal if I can't find short-term tenants. Okay. And I think they're pretty good as long as they're in the right places and the right markets and the right price range. But again, the track record is still very new. It's a very short track record. So time will tell. And we've also got to remember that during bad economic times, going on vacation is optional. And so people tend to not vacation as much. So, these are just things that you should be careful of. I'm not saying don't do it. I have a lot of friends and some of our clients that do very well with short-term rentals. But again, the track record is very small. And, that's the first thing to go in an economic downturn is vacations.
Yeah, that's definitely true. Can you tell us a little bit about any new potential rule changes on the 1031 exchanges?
Well, Joe Biden has said that he wants to get rid of the 1031 exchange, and then he backtracked a little and said, limit it to $500,000 a year, which might sound like a lot, but in the 1031 exchange world, that's not very much at all. So we're just hoping it won't happen because we love the 1031 exchange. I've got 2 of them going myself right now, personally, and we're doing a bunch of them for clients of ours. So We hope he won't take it away or limit it, but we'll see. That's up to Biden and Congress.
Do you think there's a good chance they'll do that?
Um, I don't know. I don't think there's a good chance it would go away completely, but I think it's possible there could be some limits on it.
Okay, so what would be your advice to millennials interested in real estate investments?
You know what? If you don't have the money now, save up for your first down payment and learn as much as you can. Get educated, listen to podcasts and watch YouTube channels like yours and mine, and just keep learning and getting educated. So when you've saved the money, you're ready to roll.
Oh, that sounds like a great idea. So I did have one more question, and that is if you have a house that you paid off most of the paid most of your loan off, do you think it's a good idea to take some money out of the house to buy other rental properties? What are your thoughts on that?
Absolutely. This is a strategy I call Refi till you die. And it is a great strategy. Income property is a great investment, but it's not a great bank. So it's not a great place to store your money usually. You want to get this artificially cheap fixed rate mortgages and use them for your advantage. I mean, they're a great tool to increase return and actually lower risk.
That sounds good. So, Jason, I would like to thank you for being on the show, and I hope we can have you on again soon. Is there anything else you'd like to add?
No, thanks for having me. My website's available, my podcast is available, my YouTube channel. Just go to jasonhartman.com or wherever you get your podcast, or on YouTube, just type my name, Jason Hartman, and you'll find me.
Well, that sounds great. Everyone who's watching, please check out Jason's site. And I'd like to thank you again, Jason. And I can hope we can have you on the show again soon. Uh,
All right. Thanks, Alexander. Happy investing to you and your audience.
Thank you. God bless.